Thank you. Good morning, everybody. And Hubert is born and raised in Hungary, 2012. We are facing 5 countries now, 7 cities, 50,000 square meters, 25 locations. We intend to have this doubled by end of the year. So we are only covering CEE regions.
That's good. No, that gives us everything. I
Okay,
think. That's
thank
good.
you.
Noah.
Hi, I'm Noah Steinberg. I work for Wing. We're a local developer and investor. We also have just across the river something that's more and more concrete day by day, as well as next to it some buildings that we've already built or acquired. And we're active across all the segments in the Hungarian market, retail, hotels, residential, industrial, and office, as well as some special use buildings, and we are increasingly looking around the region as well. We're also born and made in Hungary since 1999, so this is our 20th year.
Great.
Good morning, my name is Árpád Török, TriGranit. TriGranit was born in Budapest also in 1997, just if we go by this sequence. Since then we have developed, first started out mainly with retail, then moved on to also offices, mixed-use projects. So basically in the past now 22 years completed over, I don't know, like close to 2 million square meters of real estate, leasable space. Currently, we're mainly focusing on office developments, Class A office developments and hospitality. Currently active in Hungary, Poland, in several locations, and now we'll be entering or re-entering also Sofia, Bulgaria, looking at Romania, and working together with Revetas, who is our new owner, actually adding new projects day by day when it comes to overall developments.
Great, thank you. Gábor.
My name is Gábor Pető. I'm heading UniCredit's real estate practice. UniCredit is an active bank in all CEE countries, in all sectors of real estate. We are very active in Hungary also. We have signed some landmark deals last year, which, for example, Budapest or Servita project, or we are having an active role in Etele Plaza. We are the agent. I'm active in real estate sector for more than 15 years. I also spent a small time in Vienna in our regional headquarters, which is responsible for CEE financing.
Great.
Good morning, everyone. My name is Bence Vecsey. I'm with Colliers International. Well, as opposed to Wing and TriGranit, our company is not originating from Budapest. It's only myself who was born here. We are a full-service company, mostly advising clients who have property dealings, mostly in the commercial sector. We are providing services to clients in the industrial field, offices, logistics, retail, and we also have a fairly large valuation team and investment team that I'm currently responsible for.
Great, good, thank you. Let's start with you, Noah, if we can. Just in terms of Mark's presentation there, picking up on some of the fundamentals. How do you see the market at the moment? There's obviously high employment, construction costs, various things happening. What's your sort of take at the moment on the outlook for 2019, particularly for Hungary and Budapest?
I think we're very positive on the outlook for 2019. We don't expect things to dramatically improve. I liked the climbing at altitude concept, is that you're kind of up here and things are okay and you're not really going up steeply, but we don't expect, in this year at least, to see a decrease either. Our view is that the fundamentals of the local real estate market are very, very sound. So what we see in terms of the occupier markets, what we see in terms of the ability to finance our projects, we had some projects financed last year with UniCredit as well. What we see in terms of investment demand, even if we're not sellers, all lead us to believe that the outlook is positive. My view, and this is, I've said this for years, is we can look at GDP numbers, but the relevant unit for us often is actually the economic position of the capital city. And so that's a little bit different than the way the overall country GDP numbers look, and is better. And we don't see internally the sequence that would lead the markets to change dramatically at the moment. By internally, I mean domestically. Everybody feels like things have been good for a while, and so you kind of wait for the other shoe to drop, and what's the thing that you don't see? And so we try to be prudent, we try to be cautious. We always judge our individual projects on their cash flow, whether it's investment or development, and whether they seem sustainable to us in terms of the overall cash flow positions. And within that context, our view is that in 2019, certainly, things will be climbing at altitude.
Okay, good. And Árpád, you mentioned there that you're looking at also at other regions, other areas. How do you see, I suppose, CEE more generally, and particularly then the Budapest market here? Do you see investors being more defensive? What's your sense of the sort of feel in the market?
I mean, for Budapest, I think it's difficult because, as Noah mentioned, in Hungary, I think Budapest is the market. So it's unlike Poland or Romania or even the Czech Republic, where you have multiple cities and the market is much larger. In Hungary, it seems that everything is, or let's say 90%, maybe it's the wrong number, but Colliers will be able to correct me, but 90% of real activity, transactions, development is, when it comes to commercial real estate, is focused on Budapest. And I think Budapest has its limits. By size, and as has been mentioned also, unemployment is an issue, so there is a slowdown. I mean, I'm seeing a slowdown on these markets, which doesn't necessarily mean that there will be a major drop, but I'm a bit cautious compared to Noah in the sense of not seeing this increase any further, but I don't expect any significant drop either, more like a stabilization. As for the rest of, when it comes to investors, in Hungary, I think it's a very, as Mark also mentioned, I also share his views on the positive trend of Hungarian capital gaining significance in the transactions. I mean, I think they were close to 50 or 55% of all real estate transactions were actually done by the Hungarian funds, which obviously again gives a stabilization to a market, but maybe also becomes a barrier to entry to others. So it's always the two sides to the coin, and depending from which perspective you would want to look at it, because I think there are pros and cons for everything you really want to find. So it's up to everybody what view they're taking in that specific situation. As for CEE, I mean, Poland is dominant. It's unquestionable. I mean, took up, what, 50% of the overall transactional volume, and obviously a lot more diversified by location, by asset classes as well, compared to the rest of the countries. And while Poland is, let's say, 4 times the size of the Czech Republic or Hungary, and although there was a drop in the Czech Republic still did double, I think, compared to what the Hungarian market did. So it's again a matter of perspective, and you could say that the Czechs dropped with 30% compared to the previous year, but they still did double what Hungary did, while Hungary actually maintained a relatively healthy level of transactional volume. Maybe because they're running out of products, maybe because there are no more buyers, or maybe because the US funds have cashed out and you cannot really turn around the market from one year to the other with the same volume. I don't know. I mean, the only thing what I'm saying is that there's positive growth in all of these countries. There is a very positive sentiment on GDP growth for the next coming years. The major question remains is whether can we act as an island within the global sea of markets. We never managed that. I mean, we saw it in 2007, we saw it in 2002, and I don't want to go back in history a bit further, which may be a bit more problematic. I don't know. I mean, this is the major question. If we believe the CE can act as an island, then there will be stable growth for the next 3-4 years, and everything's going to be bright. if we think that, no, we cannot resist what's happening around us, and if German production is down, and as Mark said, CEE is greatly dependent on it, who knows what's going to happen with Brexit, or as a result of Brexit, US-China trade wars. I mean, if any of these will go down, or there will be a major problem, and it will have an effect on the global economy, I think that unfortunately it will have an effect on CEE as well.
I mean, interesting actually in the New York one, mostly when people have been talking about, because we've covered risks quite a lot, how people see that, because political risk especially, but global risks have become a big part of the topic, much like financing was a huge part of the topic up until about 2 years ago, and then suddenly nobody talked about financing any longer. That risk suddenly became a big part of it. And interestingly, in the UK and Germany, most of that was political risk, but also an element of interest rate risk in the UK from the US rises. But in New York, the concern there was whether or not there would be this tech boom in terms of stock markets could end up being a bubble, and that might be the issue. We can discuss that if we want, but that's just feeding back what came in from that, which was quite interesting. Some people there were seeing that a rather like the dot-com boom at the end of the 90s. Bence, let's just pick up a couple of those, because I'm interested also in when we were in Warsaw particularly, there was a lot of discussion there about the REIT regime, which had been postponed by the government there, and looking towards Hungary especially as being, you know, one of the examples of positive side of domestic capital, because it then does give international capital a guarantee that they can sell to somebody else, that there's a market there. How significant has the development of local domestic capital been that we've seen growing in Mark's presentation?
It was pretty much the local funds who kick-started the investment activity back in late 2013, but most prominently in 2014. We had a pretty slow couple of years with very limited activity generated by international capital. And local funds, they started building up large portfolios, bringing in cash, pulling in cash from small retail investors. And it was, I think in 2015, they already had close to 30% market share of orders, which steadily grew to 55% in the previous years. This goes hand in hand with the Czech Republic, where also domestic capital is very important. And as Noah pointed out, and Árpád also referred to, it's very important for the local market that international capital, they've got an exit opportunity in Hungary. We don't necessarily need to put out assets and try to market opportunities in Western Europe. Domestic capital is very considerable by size. But I think 2019 may be a slight change, as apparently the major local funds, they're reaching their property allocation, which gives them not as a purchasing power as in the previous years. So I think not only by this fact, there are also other factors which will probably result in a higher share of international capital buying properties, commercial real estate in Budapest. The number previously 55, that was extraordinary. I mean, we've never seen that number. If you go back to early 2000s, we had significantly larger number of domestic funds active in the market, but they never reached the market share above 10%. So it's indeed a very rare phenomenon that we've been witnessing.
Okay, good. And Gábor, I do want to pick up the financing area here. What are you seeing at the moment in the market? Has there been any significant change over the last 12 months? And maybe this one for you, just because it's, thank you very much for your questions coming in, that's great. If everyone is predicting some form of slowdown, whether we're close to the peak or that there's going to be some form of slowdown, will it actually happen? And are the reasons the ones predicted, by Mark, I assume, or are we missing something? So that's a what's the invisible?
I think what Bence just pointed out is really interesting, that the local funds are basically not stopping, but they will be less active. And I was just wondering what you mentioned, that international funds will take over their place. But do you think there is enough international capital to replace this? I'm sorry for answering the question with a question, but I think it's rather Bence to answer this type of question.
Yeah, it's not only the activity by the local funds that will probably prohibit Hungary to reach as high transaction volumes as in the last couple of years. I mean, we never had a period of time like 2016, 17, 2018, where activity was close to 2 billion. It looks very stable, mostly acquired by domestic capital. Well, I think if that is a real investment opportunity which ticks all the boxes, then there's certainly a very good chance that international capital will be replacing domestic funds. There are clear evidence looking at what's currently being available on the market, who are actively chasing these opportunities. And there'll be also a shift in the origination of capital. As Mark's presentation suggested, Asia is becoming now a source of capital that's actively pursuing Hungarian investments, not only Hungarian but also regional, and as a consequence Hungarian. And there are brand new investors currently regularly flying into Budapest and looking at opportunities. So I think there's a very good chance that international capital will be replacing local funds. And to some degree, this international capital has got a different valuation approach to commercial real estate. So if you're talking about the top 20% of the market, there's a very good chance that you will be seeing more and more new source of capital entering the market.
Can I have a question? I mean, I thought that the Hungarian funds were long-term holders.
Yeah.
What volume of transaction had been in the past years where they actually sold and didn't buy? This is my question, and because I don't know, maybe you're right. And since they're being long-term holders and not transacting, why would they be selling, and when would they be selling? And if they cover most of the market, how could anybody else come in and actually buy from them? And this is why I said that this may eventually become a barrier to entry also.
Yeah, the barrier to entry is probably will be lack of opportunities. There haven't been a major development boom in the last couple of years in Budapest, talking about strictly offices. We don't really have any countryside cities that could be active. It's a sad 90% of the market is Budapest based. And the developments are currently ongoing. Not too many of them may be available in the next year or so. So I think the reason why we may see a little bit lower volume this year and maybe 2020 is because of lack of product. Árpád's question or suggestion was right. The local funds tend to be long-term holders. I think it's mostly the recycling of international capital, putting back to the market, maybe a target for new market entrants.
Okay, good. Hubert, I just wanted to come to you. You're obviously active in different markets across the region. So it would be good to get a sense from you also of how you see Budapest within those other markets. Are there particular differences that you're seeing in terms of how those markets developed, but also in terms of maybe how investors perceive the markets that you're in?
Yeah, well, the main difference is that we have a history here, what we don't have in Bucharest, obviously. We have a bit of in Poland now. And that gives you, if you see how the market thrives, let's say average rent was 10 on an office, and now we are seeing asking rent 16, and we're seeing already developments going with 20, and that in a time of 3-4 years. And you ask me then, I compare that with the other 4 countries we are covering. I only see one kind of similarity, that's Kiev. And why is it so? Because we had a lack of new production. That's due to several reasons, that we have monument protection here, we don't have a CPD, we have limited land, we didn't have leverage, we didn't have finance 4 years ago. However, the result is that due to the demand, the upcoming demand, and the big question, what is the net absorption from international clients here? And these are the only ones who can drive, as long as you don't have a development in the infrastructure and economy in-house, is basically house-made, let's say like that. And if we are negotiating new properties, my perspective for the future will be 14 euro max as a kind of sustainable rent for Budapest. We don't talk about trophies, we don't talk about Sarita or something like that. And then, if you compare on the average asking rent for not only the trophies, then you see a lack. And the question is how we get this lack, right? And that's only going to market corrections. This is our point of view, how we see Budapest. However, I mean, we are already on close to 20,000 square meter here. We try to get some more, but it's not on any costs. And we try then to cover not, as I said, it's not a CPD, but still it's a Pest site where everything happens. We try to cover some other locations, as we did last year with BSQ on Buda side. Now we're looking on the 11th district. We're seeing 150,000 square meter coming available the next 12 months there. That gives us opportunities to, as the name says, act opportunistic, again with this reference of the history and the experience in the Budapest market.
Okay, good. And Gábor, just returning to that financing side, we've got, in a lot of the sessions we've had, there's been that financing is generally getting tighter. That's also witnessed slightly by the fact that I'm beginning to see more funds being launched that are specific debt all-in financing funds beginning to appear, which again suggests that maybe the financing side is getting tighter. What's your view on that? Because it hasn't been a point of discussion for the last couple of years. Do you think financing will be getting tighter and that that's part of a more kind of defensive, slightly more defensive position in the market?
Yes, at the moment, let's say 4 or 5 banks are active here in Budapest, but they are active and they are open to finance good products. They are open to finance good sponsors. But it has to be mentioned that the lesson was learned. The lesson of 2008 and before has been learned, and the banks are much more prudent than they used to be before the crisis. And it is also true that compared to, let's say, 2-3 years ago, when everybody was trying to rebuild the balance sheet of the project financing, real estate project financing, the banks were slightly more active, but I believe that we are still in the phase of high activity, and I don't see the lack of financing at the moment for good projects.
Árpád, maybe coming to you, just in terms of the lack of availability of workers. You've got high employment here. Presumably, construction costs are therefore going up. Does that make it much more difficult in terms of being a developer in the region? Is that difficult for other industries as well? Do you think just simply finding the people to work?
Obviously makes our life more less difficult, but more unpredictable, I would rather say. So what we have seen on the Budapest market with construction costs, basically cumulatively 2018, 2019 projections average 25% increase on material cost. somewhere close to 35 to 38% of labor cost increases. I mean, at least this is what is being reported by the construction companies. And obviously, a lot of things are driven by the lack of capacity or lack of available capacity. 60% of the market is taken up by the government or government-related construction activity, which obviously parallel to having commercial real estate development boom and residential development boom compared to 3-4 years ago, it does, I think, tenses and stretches the market. What I see is more like a slowdown, because I think it will result in maybe less projects happening or slower and being delayed, but that doesn't, it's not necessarily a bad thing. I think it will become an issue on the return side of the investors. I mean, the expectations they will need to give down, which doesn't mean that, you know, having 15 or 16% IRR is a bad thing, but I think eventually they will get used to it, that yes, this is a more stable market to a certain extent, but you cannot make the returns what you had been expecting from CE a couple of years back, simply because prices are going higher. Okay, there is yield compression, but it's a major question to what extent can yield compression counterbalance the increase of the construction cost and the delay in the deliverables. So.
Okay, good. There's lots of questions coming in on the serviced office side, and I'll come to those in a second. I just wanted to deal with some of the other sectors, especially, so anybody can pick these up really, but logistics, retail, obviously everybody's been down on retail in the majority of the other sessions that we've had. Logistics has been, everybody's been very keen on. Residential, everybody's been keen on. Lots of new funds being raised, particularly out of London at the moment, which are all around a concept of living. So rather than it just being student housing or just being senior living, or that actually it's under a sort of title of living, so anything where anybody wants to live. What's your sense of some of these sectors? Which do you think have got the most legs in this particular market?
Well, first of all, I'd like to thank you for the plug. We just launched our residential brand, which is called Living, which is a play, obviously, on wing and living. But to be honest, we see the markets as very healthy across all the sectors at the moment. We are very active, and we have been for 20 years, in the industrial markets. And what we see is that there was a lack of new product for a long time. Obviously, those types of buildings are very sensitive to construction costs, and the construction costs there have gone up. But that's reflected as we see it now in the rents. And we see very, very healthy demand in the market with minimal vacancy. The retail, which if you speak to people in Western Europe, is apparently dead because everybody just wants to sit at home and order on their computer. We have not seen that development yet here, which doesn't mean it's not coming. But we have seen stable year-on-year growth in the shopping centers which we own in the same stores. So for now, the habits may change and people may get less skeptical. I think there's a good degree of skepticism in Central Europe. People don't believe if they order something online they'll actually get it. And the delivery infrastructure is not here in the same way it is in maybe in Western Europe. And so retail remains, I think, both as an entertainment and leisure option, but also as a purchasing option, still very, very attractive. Residential here is a bit different from other markets just because of the fact that the vast majority remains people acquiring the apartments. So as a developer, you're selling the apartments. Whether they're subsequently rented out or whether the actual occupier is the buyer is a bit different, but as a developer, you're building on a much shorter term basis for a market that assumes that you're selling the apartments. And there has been a tremendous boom in tourism, so the hotel markets remain very, very strong here, and there's a lot of new supply coming in. Overall, as a result, what I would say is that the overall property markets, and again, there are two different markets, and I think it's important to differentiate. One is the investment market, and we've touched on that about, whatever however many billions of euros it is, and investment demand both from domestic buyers and from international buyers. And the other is the local occupier market. And again, we always look at that first. So we always look at sustainable rents, sustainable financing, and a project justification. And if we can sell it, it's great. But if we can't, it's also fine, as long as the project supports itself. So my view very much remains that it's important to be prudent as a developer. As Gábor said, the lesson was learned in 2008. What I would say is, phrase that a little differently, I would say that, we at least, those of us who lived through it, probably remember it. And as a result, that factors into our decision-making on a day-to-day basis.
Okay, good. Bence, just in terms of the retail side, do you share the same view? And what's happening here with logistics? Are you beginning to see an increase in e-commerce, and do you think that will have an impact or an influence on retail here?
According to data so far, e-commerce hasn't really affected traditional behavior of retail customers. As Noah said, if you look at occupancy rates in dominant shopping centers, they've been constantly 100% massive rental growth being witnessed in shopping centers. So far, retail looks good. I think it's important to highlight that in Western Europe, retail penetration is significantly higher than in this part of the world. Budapest, not only in the region, but on a European basis, we have probably the lowest retail space per capita. So basically, the stock is very low compared to regional peers and Western Europe. But there's no denial, e-commerce is coming. There are new occupiers setting up businesses, existing ones growing. Bottleneck is availability of space for such occupiers. City logistics, last mile delivery, there's simply no stock currently available for such occupiers, and the development hasn't really started in that field. So there's momentally there's a natural stop on creating or providing the necessary space for major e-commerce retailers.
Okay, good. One of the interesting things from the sessions that we've had so far as well was, although people were down on retail generally, actually, if it was a good asset in the right place, people still felt that would perform well. And the idea that shopping has died seems to me to be complete insanity, because shopping has been going on for thousands of years, so I can't see that changing entirely. It may adjust a little bit, and shopping was very different 100 years ago to now. But it'll be interesting to see how that develops here for certain. I'm going to look a little bit now at the co-working space, because we've got loads and loads of questions on that. So I'd like to pick that up. So I'll go to the top one, which is serviced offices are closing expensive long-term leases now. When the downturn comes, how will they be able to adapt their pricing to retain SMEs, small and middle-sized businesses? Who would like to tackle that? That's
Yes, as I said, if somebody signs a 16 or 18 euro lease in Budapest, that's expensive. I agree. And I have no clue how they want to cover that. It's all about sustainability. I mean, if you have skin in the game like me, I'm still 80% shareholder, and it's my retirement business, so I would be very cautious to sign over-rented lease contracts. But if I would be driven, pick it up, right? We only anyway coming up by California and Tel Aviv seed money, which they tell you if you don't burn, you don't grow enough, fast enough, then I don't have any problems with that. I just spend the money and I see what comes up, and I will try to get in the market leader. So the question is, where do you come from, and where do you want to go, and where you want to be? What's the scaling and the measurement schemes of your investors? We have a clear mission. We can't burn money by the by our investors. It's all European, so they say it's not accepted. You can make a black or a red zero, but don't start 50 cents of the dollar revenue burning. While WeWork has a clear mission from SoftBank, you have to get the market leader, and whatever on whatever cost it is, make it done. And that we don't know what is the end of the game, but we know it's not sustainable. Coming back to the crisis scenario, it will not be a crisis. I fully agree with the panel. It's not the 2008 event, which we will see. We will maybe see a 2002 event. So a small correction will do the job. And if there is a market correction, it will drive the tenants to flexible workspace solutions, that's for sure. So even so, we will have higher occupancy on traditional space, vacancy, sorry, then it's not the same time said that it's in the disadvantage of flex office providers.
Okay, great. And Árpád, so Hubert, WeWork, people like that, are they, do you see them as a great new tenant? Do you see them as a disruptor? You don't need to, that's not necessarily Hubert personally, but do you,
I like Hubert personally.
how do you, I suppose, how do you see the WeWork phenomenon? Do you think it's something that is the serviced office phenomenon? Is it something that's just been adapted? There's questions coming about, is it really a new space for millennials? What's, I suppose, what are the trends? Do you see it as a disruptor, or do you see it as just a different form of tenant, really?
I think we have to make a distinction between co-working, flexible office space, and these type of operators, because there's a huge mix-up between these. I mean, serviced office has been on the markets for, what, 30 years now, with, I cannot mention the name, but you all know which company actually became very successful out of this. Co-working also been a phenomenon in the US for the past, I think, also close to 20 years now, when basically was boosting the startup businesses, and local operators started sharing offices. At the same time, co-working as part of a concept of flexible office space, part of the, for large corporates, they have started revising their offices with hot desking and other concepts. I mean, I remember I was with Cushman, and it was like beginning of 2000 when in the London office it was already a hot desking thing, and we have seen it with other companies also doing this phenomenon. And then we talk about the flexible office space, which are the WeWorks, the Mindspaces, and the New Works, where it's multiple locations globally. I think that's very important, with actually selling a lot more. I mean, I have had that discussion with with WeWork, and they showed me, I saw their offices, they showed me around in their offices and in London, and they said, oh, this is the social place. I said, this is like Tinder. I mean, basically people are sitting there, and they're okay, I like that person, I don't like that person. So it's a totally different concept compared to co-working or serviced offices. And then coming back to your question, I mean, I see this as, it's here. Globally, it's a very strong trend. I think the question is not really whether this concept, or even as a developer, whether you should deal with this concept and have that concept in your development, but the main question is who? Out of these market players. I mean, who will be around for the next 10 years, since they tend to sign long-term leases? Who will actually be able to be competitive on a regional basis? Because, you know, we were occupying half of Manhattan or fully, and London doesn't necessarily mean that they will be successful in Budapest or, let's say, Warsaw or in the region. And especially with this, they're burning around, what, 2 billion euros last year? That was their burn rate, 2 billion euros. I mean, I think most of us could build a very, very successful business of, let's say, 20-30% of that money if it was given to us, and not having to do this. It's the billion-dollar question. Who? I strongly believe that this concept will remain. I don't know who's going to be the winner in this. I also see them as disruptive to a certain extent to the, let's say, traditional office developers. So I think office developers will need to, they have two options. One, they team up with one of these operators, or the other one is the others have started doing Skanska, HB Reavis to create their own brand. However, I have a different opinion about this, because why reinvent the wheel when you have operators who you can actually work with? And they could only manage this, and I guess the bankers will confirm that, if they run this as like a separate business unit and not as an integrated service line within the property development, because they would need to, yeah? Is that correct, or?
So co-working is, let's say, a very trendy phenomenon now. And what I have to say that banks are not the leaders of the change of the office for sure, but we are also now planning our refurbishment of the headquarters, and actually we will have our own co-working area, because what we see is that I mean, based on remote working, everybody was afraid that office is not needed anymore. But it is now proven that offices are needed, because we are social beings and we need to work together. But office has to answer this phenomenon. And I think, as today I see from Hungary, the best answer is this flexible workplace, the co-working area, and such, which we will have. So every company has to face the volatility of the occupancy of the desks, and sometimes it's above 100%, and the best answer is not long-term lease, is the short-term lease, and co-working gives a good solution for that. That's why I think it's needed. As in case we are financing a project where a co-working tenant is in the office, I think we shouldn't judge this co-working tenant differently to a normal tenant. So why XY company shall be judged the same as a co-working company? So if we think that this company is sustainable, then we would accept as a tenant, and we would move further on the financing. But this judgment first shall come from the developer, who is more experienced and more closer to the product. So in case our sponsor is supportive for this deal, I think the bank would be also supportive, but we should have the right balance in tenancy mix, location, loan to cost, and etc.
So from your point of view, a tenancy mix is key, rather than there being a single co-working, rather than an office being let purely to a co-working company.
I cannot give a yes and no for this, because as you see, we finance Servita project where the single tenant is a co-working company, so we believe in that project and that concept, but each project shall be judged separately. So if you have a good product with 15-20% of co-working area, then I think that also could be the right balance. But to have a building with 20-30,000 square meters of co-working, I might be afraid to go forward.
Okay, and Hubert, in terms of the demand, in terms of space, in terms of fit out, in terms of what people are looking for, what are your tenants or your guests, or what are they looking for? What are you having to put in that makes either, are you having to change that to keep your tenants happy? Are there specific things that they're looking for, trends that you're picking up?
Well, the thing is flexibility in services. That's the main driver. And then you have to be very specific in client care. So we're talking about hospitality, which we do not know from the office industry so far, and availability in terms of moving in 24 hours, basically, which we do not know from the office sector so far. And I guess we're just working out a concept how we can optimize the leasing process. And if you analyze that and you're working on the paper, you see there is a landlord representative, then there is a broker, then there is a lawyer, then there is a project manager, then there is an architect for design. It needs about 2 weeks to getting a viewing. It gets another 3 weeks to get the cost estimation. It needs about 2-3 months to get a lease conducted. And this is not in the favor of our clients. And the trend is that the corporates, due to the new IFRS regulations, International Financial Reporting Standards, due from 1st of November, January 19, having a clear guideline that a third of the entire space that you're occupying, I talk about internationals only now, should be on flexible terms. And that means the global city in Europe for flexible office solutions is London, with today 14-15% market shares of the stock, goes up to 30% the next 5 years. And the CEE capitals, with an average of 3 to 4% on office stock, will go up to 12. So it's not a question if this is not, a flu which comes and goes. This is something which keeps sustainability for the future of the office market. And why is it so? Because we are all driven by digitalization. And we can't imagine a world without web or e-commerce or whatever is the driver. So we better get used to this fact, right?
I've got a quick question that I have to ask you, really, which is, are the co-working centres really adding value or just selling overpriced desks in a millennial atmosphere? And then we'll ask everybody else after you, Hubert.
Okay, define co-working. We should really start there. What is co-working? Co-working is Starbucks. That was the first co-worker, right? Then Lufthansa came along with an airport lounge where you're getting an internet connection and all the third workplaces. This is co-work. Has this anything to do with office? Rather no, yes, might be. So a co-worker signs a ticket like for a gym, for a day, for an hour, for a month, if you're happy for a year, and it's a nomad, and he goes and disappears like a daily fly. Then the next generation or the next product line is Flex Office. Yes, this is in the market for 30 years. There we have a market leader, it's called Regus. They missed the trend, so they closed the Regus branches. Now it's called Spaces, which is just, the same wine in new barrels, right? And then we have these corporates. And the corporates, yes, this is a new trend, and this is the driver for WeWork. So you only can lease 10,000 square meter if you're going for clients who sign in for 800, 1,200, 1,500 square meter, because the demand on Flex Office, what we call workstation clients, is limited in all markets. You have 400 leads in Warsaw a month, you have 200 leads in Budapest a month, and that's it. And the lead is about 5 workstations. This is an average size of 40 to 50 square meter GLA. So you can make the math very easy where these guys are ending, right? And that's it. The market will not grow because of digitalization anymore. And going to this chart, 60 office centers in Warsaw nowadays, you take off the co-workers, you're ending up with 30. You're taking off everything which is down 2,000, smaller than 2,000, you end up with 12. So that means the amount of operators is disruptive. And we will see a lot of bad press out of the sector because you all call it co-working, right? Yes.
Okay, good. Good. I want to pick up one quick thing as well, Bence, with you. Just, do you think, because obviously there's some co-working space in, there's some office outside of Warsaw, obviously in Poland, less so here. Do you think for secondary cities, this co-working kind of phenomenon may introduce more opportunities for office space outside of the major capitals?
We've seen indeed a few centers outside of Budapest. They sort of open up the market for countryside SME businesses in these operators. I think the issue at the moment is, again, lack of space that these operators could sign up with. But certainly, this is a realistic scenario for the future. Countryside offices being operated as flexible workspaces, but developers, they don't really want to pioneer into secondary cities and build a 5 to 25,000 square meter office building. They're purely speculating that a co-working operator or a flexible space operator would sign a lease agreement. We have two developers on the panel. I think they can certainly address the issue and perhaps iterate a little bit whether they have any such requests in the past. But I would be very much surprised if that was the case in Budapest, in Hungary.
Any move towards secondary cities because of this, or no real demand, do you think? Yeah,
Looking at me. I think it was said by Bence in the introduction that or Árpád, that the market outside of Budapest is very limited, period. And even if you do a build-to-suit for a major occupier, the question is always at the end of that lease, what is your opportunity to release? What is sustainable in Nyíregyháza or Debrecen or on a long-term basis? Our focus is not entirely, but it's largely on Budapest. One of the things that I think, listening to this discussion, it's important to keep in mind is that there are two questions. One is who the occupier is of the space, and the other is the way the space is used. So we signed a long-term lease for Hungarian Telecom. It was one of the largest leases in Hungary, which is to a major corporate occupier. Within that space, there are a lot of elements of a more modern workplace. There are lots of breakout areas. The bulk of the offices is a hot desk to begin with. There are lots of recreational opportunities. There are lots of things that 5 or 10 years ago we wouldn't have seen a corporate occupier requesting that we do now. And they do that to retain their employees and to give flexibility and to allow the company to work as a modern 21st century company. As a developer, we look at the stability of our occupiers. So what we really want to see is how will the space be used and who's going to be paying for it. I am an owner and a developer of hotels. I'm not a hotel operator. And when we first started in the hotel business, the way it was explained to me, which has stuck with me, is that when you do a 5,000 square meter office, you have to agree with one tenant and you've leased that 5,000 square meters for 10 years or whatever it is. When you run a hotel, you have to lease every room, every night to somebody different. And that's a specialized knowledge, as is the way that you deliver room service, as is the way that you clean sheets, as is the way that you provide breakfast. And that's not the business we're in. So if we are looking to how, as a developer and investor, this impacts the market, it impacts the market in as much as the people who are prepared to take the risk are prepared to lease space from us on a long-term basis, and our view that their balance sheet and their covenants are sufficiently strong that we're prepared to take the risk to give them that space. And I think that's how we view it. How the space is used is a different thing, and we're very flexible in accommodating our tenants' needs on that. How we lease it out has to be, however, unless we make the decision to go into that operation and become a serviced office provider, basically, or a co-working service provider, whatever it is. Otherwise, what we're looking at is who will be the tenant, and are they a sufficient covenant that we're comfortable developing for them.
Okay, good. And Árpád, just in terms of, there's a question that came in about whether or not co-working necessarily needs to be purely in an office, or could it also be as part of a mixed-use development, whether there's retail there, there's office there. What's your sense of that? Mixed use has been one of the big topics that's come up in general. Do you see that as something particularly here for this market as well, in terms of development?
I mean, there's been a strong trend in retail. You were just discussing retailment, which actually a lot of retail centers started doing or providing co-working spaces in Western Europe and North America. Hotels are doing this as well. So actually focusing more than not just giving the business lounge part, but actually working out concepts or a combination of these. I've spoken to I would rather call them flexible office space operators, not co-working, because in my dictionary, co-working means totally different. Either it's part of a solution for a corporate within their offices, or like a standalone operator in a given city providing space. So flexible space operators have confirmed, for example, that they love to have a hotel next door, or be in an area where you have several restaurants, because that they actually work together. So to answer your question, very simple question, I don't think that flexible office space co-working is exclusively basically has to be in office areas or specific designated office buildings. Anything in between coming from the flexibility. There's one major question though, and this always, and maybe I'm asking this from Hubert, that how do you solve security issues for large corporates on servers, other things? And the other thing is that I see that the flexi office space operators will want to track their occupancy of checking how many people, I mean, you know, how they use these areas. How does that work with the European Union GDPR's regulations? Because this might make this a bit more complicated, no?
Coming to the security aspect, security is invisible these days. So you have all the technologies available in the market to provide
cybersecurity.
To provide security. So you're going with your chip, and you only open the doors, and you only enter the floors, and only enter the building in the times you're allowed to. And it's not necessary to have a security guard. That's only a visible contact for the client. There is somebody who takes care. It's due to government relation, to requests on the fire department, stuff like that. You need the physical person, but the algorithm is much more better than any guard. So security is really not an issue. Yes, we are running a business park in Prague. It's 4 floors, each is 700 square meter, and we have IT company. They require to 1 floor. They are developing whatever for a pharma concern, a big corporate, and they want to have their own card readers. So give them their own card readers. I don't care. I just take mine out and give them their own. If they're happy, I do it. They want to have their own server room, give them their own server room. If we don't have one, we reinstall a storage one.
So we can maintain these.
This is all about flexibility, and that's done in 24 hours or 48 hours, right? He want to have a door in the wall, and then he gets a door in the wall. And that's done overnight as well. And I guess this is the main thing, that, again, yes, I have no clue how this is in line with GDPR, but we will find a solution for it.
No, I meant that I've seen other, not yourselves, but other operators actually wanting to track, you know, people, how they move in the building for occupancy, other things.
If you have
But it raises questions.
Well, if you have the systems, you are trackable, you're traceable. I mean, we installed in Anchor, because of vandalism, the CCTV. So you put a sign out there, CCTV. The client signs in, and he gets the chip, maybe under his skin. And yeah, then he has to sign, I know, the chip is under my skin, and I'm traceable.
My brother is watching.
Yes, I mean, that's the end of the story. We tried to implement a chat boot, it's called. Basically, it's a Tinder or a Facebook function for all the tenants, for business mixer, for business acceleration, for exchanging experience, whatever, doing basically business all over CEE together, because the coder in Kiev want to have a job, and the guy in Warsaw desperately looks for a coder, right? So why not bring the guys together? Again, it's related to data security, but if they're signing in, knowing what we're doing, I don't see a problem with that. But it's a challenge. You need 2 educated guys doing only this. That's clear.
But so in terms of the cost for fit outs and for those kinds of things for this type of office, is that more expensive, and therefore who pays for that? Is that paid for? How does that work? Does it make a difference in terms of how the market perceives it?
I think that's a very good point. I mean, these operators, they tend to fit out their offices rather extensively. I mean, in the past it was different. Some operators just signed up already working, functioning office space, taking over from a previous tenant, spending little cash on improving the space. But the concept, at least the top end of the market, the concept has changed for the better. And some operators, they allocate in a considerable budget for fit out. No need to say that these operators, they tend to create more breakout rooms, more conference rooms, more meeting rooms. So the cost of such fit out is significantly higher than you would face with a standard tenant coming from the market. I think it comes down to the negotiation, or it should come down to the negotiation between the parties, the developer, the landlord, and the operator, who is covering what part of the cost. There are examples in the world where the landlord is also participating in the risk of running such space. I mean, there may be a combination of a base rent, and then there's a turnover or occupancy related rent that is paid to the developer. In such case, I think it would be fair from the operator to ask the landlord to contribute an extensive amount into the fit out of such space. When it comes to investors, that's also again a question. I mean, if the cost of the fit out is higher and it's provided for by the developer, there has to be compensation through the rents. And then if the asset comes to the market and then you have an operator who's paying an excessive rent of 15 to 20%, how's the investor valuing it? So it's a complex situation. There's no rule of thumb, I believe, and honestly, we haven't seen that many transactions which is concerning flexible office space operators. Yes, there have been a few transactions with an occupancy of 20%, 25% component-wise, but a pure 100% flexible workspace leased office building, that's very rare in this part of the world.
Okay, good. We're pushing up against time. So has anybody questioned either that I haven't asked that they've put in, or that you would like to ask now? Yeah, Gary, go ahead.
Could the panel give a definition of co-working space, or what is your working definition? I've heard about 3 or 4 definitions from different people. So,
maybe I pick it up for you, Gary. What is co-working? Co-working is driven by community. Co-working is driven by socializing. This is why Starbucks sells more coffee as the people staying longer. They start staying longer because of the coffee, because there's socializing. And that has to do, and that was the main innovation from WeWork, was to pick that asset, which of course comes from US, always, like the Facebooks and the Tinders of the world coming from there. And this socializing and community stuff is a part of the marketing, right? It goes down the importance. We have surveys for clients' needs, and we cluster co-working, flex office, and corporates. So a co-worker is maybe one guy for a hot desk, the flex office may be somebody up to 5 workstation, and the corporate starts 20 plus. Means a 200, 300, 400 square meter client is a corporate for us. And the needs of these groups of clients are completely different. What they have in common is flexibility, availability, and kind of services. What is completely different on a corporate side, they're looking on corporate standards, security, GDPR can be, I don't know, stuff like that. What's on the other side of the table, the coworker likes his pizza and the beer, right? So as more pizza and beer you see, as more it's co-working. And in the middle of the flex office, if these are the three product groups we can talk of, you don't see it anymore because nobody want to have it. And that's true for living as well. It's more you're going to the co-working sector and you read in the press about co-living now. It's more on the co-working side because the corporate goes in his hotel, in his boarding house, or in his service departments, and that's it. He doesn't want to share his mattress, right, or the bathroom. And that's basically it. So it's driven by community, again, digitalization. The nomads are classic co-workers, while the corporates are no co-workers. However, yes, they want to have a bit of event management. They want to have a bit of outsourced HR, procurement management, stuff like that. This is what we're calling additional services. So again, three products: co-working, flex office, corporates. Underlying value, additional services. And the amount which service is getting picked up is driven by the demand of the client, which only has a small common area and a lot of diversifications there. Does that answer the question? Kind of?
Would Noah define his Ericsson building as co-working space? It seems lots of people in shorts and bad trainers and pizzas and so on. In your
That was a building which was leased on a long-term basis to a major corporate client. How they choose to use the space is obviously done in conjunction with us as the landlord, but I would not define it as a co-working space from our point of view. Again, they have all sorts of functions in there. They have the Ericsson Garage, which is specifically focused on startup technology, on new developments, on bringing in students, on bringing people from outside. They have catering options at a bunch of different levels, which allow people, I don't think we serve beer, but can, eat in different ways, can use the space in different ways. They have a lot of collaborative space. They have a lot of terraces. They have a lot of amenities, which make it a modern workplace. From our point of view, however, we leased the building on a long-term basis to a major corporate client, and from our bank's point of view, the same thing happened.
You can either answer, what do you see as the biggest trends, or you can answer, where do you think the best opportunities are at the moment in the region, and you can stick to Hungary and Budapest should you wish. Let's start with you, Hubert.
Well, that's easy because it's the flexibility of office space and in all the markets we are in.
Okay, good. Noah.
I think for us, the biggest trend at the moment is a stabilized and maturing property market, right? That was what we see across all sectors, is the ability to function normally. I agree with what Hubert said. We don't see a downturn coming right now, and if we do, it's much more likely to be something that's a bit more gradual than what we experienced 10 years ago, 10, 11 years ago. Our view is that the trend at the moment is that the markets are functioning. The leasing markets, the financing markets, the investment markets, and there's ability to develop and to acquire property.
Great. Árpád.
If we believe in this, then CE definitely for the next 2-3 years. And as a trend, I mean, I have to agree that co-working flexible office space is a very interesting trend, and it is affecting the future of office developments to a certain extent, because I see them as like a specialized property management company, which with special skills and the ability to secure locations. And so yes, CE, flexible office space combined with developments.
Okay, good. Gábor.
So for me, the most sexy sector now in Hungary is industrial, because there what I see is the risk reward is the best, because there is lack of pipeline, there is smaller construction risk involved, shorter construction period, and actually the vacancy is record low. Though it has to be said that the transaction volume is much smaller compared to office or even retail, but still here I see the most growth and most focus area for us.
Okay, good. Bence.
Investing today, I would also go with industrial and light manufacturing, with a combination of a little bit countryside but heavily heavily towards Budapest. Medium to long term, I would say certainly offices. I think it's undeniable that they have the best run in the 5 to 10 years. So, I mean, it'd be a combination of the two. If I'm aiming for the long term, it's offices. But today, as for a quick trade, it'd be industrial logistics.
Okay, good. Thank you.